Phase 1. The temptation. Nobody tells you that the most exciting investment of your lifetime might be the one that quietly destroys a decade of progress. Nvidia goes up 239% in 1 year. Everyone knows someone who bought Nvidia in January and retired the conversation about ever needing a financial plan. The number feels like proof. Proof that the boring advice was wrong. Proof that index funds, the thing every financial advisor has been putting you to sleep with for 20 years, are for people who are not paying attention. AI is the future. Everyone knows this. The question is not whether AI wins. The question is whether you are in it before the rest of the world figures out what you already know. Two people had $30,000 in that question at the same time, both informed, both disciplined, both wrong about what mattered most. One of them answered it one way. One of them answered it another. 3 years later, the results are not what either of them expected. Phase 2. The starting line. Austin, Texas. January 2023. You and Ryan, both 31 years old, both making $74,000 a year, both with $30,000 saved. You have been following AI since GPT-3 made headlines in 2020. You understand the technology better than most people in your office. You have been reading earnings calls. You have been tracking compute demand. You know what CUDA cores are. You know why Nvidia's moat is real. You are not guessing. You are informed. Ryan is also informed. Ryan has been reading about index funds since he was 24. He has read the studies. He knows that 85% of active fund managers fail to beat the index over 10 years. He knows what an expense ratio actually costs over 30 years. He knows that Warren Buffett told his estate to put 90% in an S&P 500 index fund. Ryan finds this boring. He invests in it anyway. You find Nvidia significantly more interesting than the S&P 500. You invest in what interests you. Same $30,000. Same month. Same city. Different everything else. Phase 3. The decisions. You build a portfolio. Not recklessly. You are disciplined about this. You research for 6 weeks before placing a single order. Your allocation. Nvidia. $9,000. 30%. The picks and shovels play. Every AI model needs their chips. Demand is structural, not cyclical. Microsoft, $6,000, 20%. Azure AI integration, OpenAI partnership, enterprise adoption at scale. Google, $4,500, 15%. Gemini, cloud. Search dominance threatened, but defensible. Buying the fear. AMD, $3,000, 10%. Second mover in AI chips. Cheaper than Nvidia, growing market share. Meta, $4,500, 15%. AI infrastructure investment. Llama models. Ray-Ban glasses. The contrarian play after the 2022 crash. Cash, $3,000, 10%. For opportunities, for corrections, for discipline. You have a thesis. You have diversification within the thesis. You have a watch list. You have price targets. You have done everything a serious investor is supposed to do. Ryan opens his brokerage account. He transfers $30,000 into a total market index fund, VTI, Vanguard, total market ETF. Expense ratio, 0.03%, 3,700 stocks, automatic dividend reinvestment, on. Monthly contribution, $500, automatic. Before he sees it, he spends 11 minutes on this decision. Then he closes the app. He does not have a thesis. He does not have price targets. He does not have a watch list. He has a boring fund that owns a piece of every significant company in the American economy, including all of your AI picks, plus 3,695 other companies you decided were not worth your time. He goes back to whatever he was doing. You go back to your Bloomberg terminal. Phase 4. The ride. January to June 2023. You are a genius. Nvidia reports earnings in May. Data center revenue up 171%. Stock jumps 24% in 1 day. Your $9,000 Nvidia position, $14,200. Microsoft announces Copilot integration. Enterprise customers are signing. Your $6,000 Microsoft position, $7,400. Meta is recovering faster than expected. Your $4,500 Meta position, $7,100. Portfolio value by June, $43,800. Up $13,800 in 6 months. 46% return in 6 months. You tell Ryan about it over lunch. Ryan's portfolio, $34,200. Up $4,200 in 6 months. 14% return. You are ahead by $9,600. You feel the gap like a physical thing, like confirmation of everything you believed about AI and about yourself. Ryan orders his sandwich and does not change anything. Ryan is not comfortable either. In March 2023, the fund drops 8% in 2 weeks. Ryan checks the account once, closes the app, does not check again for 6 weeks. The discomfort is real. He just does not act on it. That is the entire difference. July to December 2023. The second half is different. Not for Nvidia. Nvidia keeps running. By December, your Nvidia position is worth $22,400. But the rest of your portfolio starts to remind you that concentration is a strategy that works until it doesn't. Google misses estimates in October. Your $4,500 position, $3,900. AMD reports strong numbers but guides below expectations. Market sells the guidance. Your $3,000 position, $2,400. You buy more AMD on the dip, $1,500 from your cash reserve. The dip continues. Your AMD position, $3,200 total invested, worth $2,100. You are learning something about the difference between being right about a technology and being right about a stock price. They are not the same thing. They have never been the same thing. You knew this in theory. You are learning it in practice. By December 2023, your portfolio, $51,200, up 71% from $30,000 in 1 year. Ryan's portfolio, $42,800, up 43% from $30,000 in 1 year. You are still ahead by $8,400. The gap has narrowed from $9,600 at the June peak. You do not notice this. You are focused on the 71%. 2024, the rotation. January arrives with a new conversation: interest rates, valuations. The question of whether AI revenue will ever match AI expectations. Nvidia reports again in February. Numbers are extraordinary. Stock goes up 16% in 1 day. You feel vindicated. Then something happens that nobody fully explains until after it has already happened. The market starts rotating. Not out of AI. Out of the specific stocks that ran the hardest. Institutional money starts trimming positions. Not because the thesis is wrong. Because the positions are large and the profits need to be realized before the quarter ends. Your Nvidia position goes from $26,000 to $21,000 in 3 weeks. You do not sell. The thesis is intact. The technology is real. You are right. The stock keeps going sideways for 11 weeks. Then in June 2024, something else happens. Meta announces it is spending $37 billion on AI infrastructure in 2024. Not revenue, spending. The market reads this as either visionary investment or value destruction, depending on which analyst you follow. Your Meta position, which had recovered to $8,200, drops to $6,400 in 4 days. You hold. You have been holding. Holding is the plan. Ryan is not holding anything. Ryan is not doing anything. Ryan's portfolio in June 2024, $58,400. Your portfolio in June 2024, $52,100. Ryan is ahead, not by a little, by $6,300. Phase 5. The hidden cost. You do a calculation you have been avoiding. Time. You have spent approximately 4 hours per week managing this portfolio. Research, earnings calls, news, checking prices, reading analyst reports, second-guessing decisions you already made, making new decisions about whether to hold or trim or add or rotate, 4 hours per week, over 78 weeks, 312 hours. 312 hours of cognitive effort applied to a portfolio that is currently worth less than Ryan's, which received 11 minutes of setup and approximately 45 minutes total of attention over the same period. You have also made 14 individual decisions about this portfolio in 3 years. Buy, sell, hold, add, trim, rotate. Each decision felt informed. Each decision had a reason. 7 of the 14 were correct, 7 were wrong or suboptimal. A 50% decision accuracy rate on a portfolio you spent 312 hours managing. The index fund made 0 decisions. It was right 100% of the time. Not because it was smart, because it had no opinion to be wrong about. You have also paid taxes. You sold your Google position in November 2023 for a small loss. $600 loss harvested. You sold half your AMD position in March 2024 after it recovered. $800 in short-term capital gains, taxed at your ordinary income rate. Ryan has sold nothing. Ryan has 0 taxable events. Ryan's entire portfolio is growing tax-deferred inside an account he has not touched. There is also the psychological cost. You have not slept through a single major earnings week in 18 months. The Sunday before a big earnings report has a specific texture now, a low-grade tension that starts around 4 p.m. and does not leave until the after-hours numbers hit. Ryan sleeps on Sundays. Ryan does not know when Nvidia reports. Ryan does not care when Nvidia reports. Ryan's relationship with money is calm. Yours is not calm. You have not identified this as a cost yet. You will. Phase 6. The comparison. January 2026, 3 years. You and Ryan are at the same restaurant in Austin where you have been going since you both moved here. You both know the menu by memory. Your portfolio. Nvidia. $31,200. Still your largest position. Microsoft. $9,400. Meta. $11,800. AMD. $4,100. New position in TSMC. $3,800. Cash, $1,200. Total, $61,500. Up 105% from $30,000. Over 3 years. You have also contributed approximately $8,000 in additional capital during dips and corrections. Adjusted for contributions, true return on original capital, approximately 82%. This is exceptional by any objective measure. Ryan's portfolio, VTI, same fund, never changed, never thought about changing it. Total contributed $30,000 original plus $500 per month for 36 months, $18,000 additional, $48,000 invested. Portfolio value, $74,200. The total market returned approximately 18% annualized over this specific 3-year period, driven substantially by the same AI stocks you own individually, plus the rest of the economy. Ryan owns Nvidia, Ryan owns Microsoft, Ryan owns Meta, Ryan owns AMD. Ryan owns all of them inside a fund that also owns 3,695 other companies that quietly grew while you were not watching them because you were watching Nvidia. Ryan has $74,200. You have $61,500. Ryan is ahead by $12,700 after 3 years of 4 hours per week, after 312 hours of research, after earnings calls and analyst reports and Sunday tension and 2 taxable events and 1 position you should have sold and didn't and 1 position you sold and shouldn't have, Ryan is ahead by doing nothing. Phase 7, the truth that changes everything. Here's the part nobody says out loud in the AI versus index fund debate. You were right about AI. The technology is real. The revenue is real. Nvidia's moat is real. The thesis was correct. You were right. and you still underperformed a fund that required 11 minutes to set up and 45 minutes of attention over 3 years. How? Because being right about a technology and being right about when to buy and when to hold and when to trim and how to size each position relative to the others and how to manage the tax implications and how to not sell at the bottom and how to not buy too much at the top, being right about all of those things at the same time for 3 consecutive years is a different skill than being right about the technology. Most people are right about the technology. Almost nobody is right about all of it at the same time, for long enough to beat a fund that is right about nothing and owns everything. Ryan did not beat the market. Ryan was the market. You tried to beat the market. You failed. Not because you were wrong, because beating the market requires being right about more things than any single person can consistently be right about. The 85% of professional fund managers who fail to beat the index are not failing because they are uninformed. They are failing because they are human, because they have opinions, because they have conviction, because they have the specific and expensive belief that their understanding of a situation is more accurate than the collective judgment of every participant in the market reflected in the price. You had that belief. It cost you $12,700 and 312 hours over 3 years. This does not mean you should not own AI stocks. This means you should understand what you are paying to own them individually, not in fees, in time, in attention, in the Sunday texture before earnings, in the decisions made at 11 p.m. when a position moves against you and you have to decide whether the thesis is intact or whether you are rationalizing a mistake you are not ready to admit. The index fund does not require any of that. The index fund requires that you believe in the long-term growth of the American economy. If you believe that, and you should, because it has been true for over 100 years, the index fund gives you that belief for 0.03% per year and 11 minutes of your life. Ryan is not smarter than you. Ryan is not more informed than you. Ryan just understood something specific that took you 3 years and $12,700 to understand yourself. The goal was never to pick the right stocks. The goal was always to build enough wealth that the money stops being the thing you think about on Sunday afternoons. Ryan got there first. Not because he was right, because he stopped trying to be. Somewhere right now, a 28-year-old is watching Nvidia go up 15% in after-hours trading. They are about to open their brokerage account. They are about to feel certain about something. They should feel certain. The technology is real. Just make sure you know what you are paying to act on that certainty. The price is almost never in dollars.